Let's move on to one of the most important accuracy checks in bookkeeping, bank reconciliation. Bank reconciliation is simply the process of comparing the business's cash book, our internal record of bank transactions, with the bank statement provided by the bank. We do this to make sure both records show the same balance. Why is this necessary? Because timing differences and errors can easily occur. The bank may record something before or after we do, or we might have missed a transaction altogether. The main purposes are to spot timing differences or errors, to confirm the real balance available in the bank, and to detect fraud or missed entries before they become bigger issues. It's completely normal for the cash book and bank statement not to match exactly at first. There are many legitimate reasons for this, and understanding them helps you reconcile accurately. Common reasons include: first, outstanding checks. These are checks we've written and recorded, but the bank hasn't cleared them yet. Until the supplier cashes them, they don't appear on the bank statement. Second, deposits in transit. That's money we've received and recorded, but the bank hasn't processed it yet. Third, bank charges. The bank may deduct service fees automatically, and we only find out when the statement arrives. Fourth, standing orders or direct debits. They are automatic payments that the bank processes but haven't yet been entered in our cash book. Let's look at our full bank account reconciliation example to see how it works in practice. We start with the closing balance from the cash book, in this case, £3,000. We notice checks for £500 that haven't yet cleared, so we add them back. Then we subtract £50 for bank charges that the bank has recorded, but we haven't yet entered. £100 standing orders processed by the bank, but haven't yet been entered in our cash book. £1,000 deposits in transit we've received and recorded, but the bank hasn't processed it yet. Once those adjustments are made, both the cash book and the bank statement show the same adjusted balance, £2,350. That's the goal of reconciliation, to identify the differences, adjust for them, and end up with matching figures on both sides. The adjusted balances must always agree. If they don't, it means something is still missing or wrong. Here's the step-by-step method you'll use when preparing a bank reconciliation. Step 1. Compare the entries in the cash book and the bank statement line by line. Step 2. Tick off all the matching transactions. Step 3. Highlight anything that doesn't match or is missing. Step 4. Make adjustments in the cash book for any items not yet recorded, such as bank charges or direct debits. Step 5. Prepare the reconciliation statement showing how the cash book balance and the bank statement balance line up. And finally, Step 6. Make sure that after all adjustments, both balances agree. It's a very logical process. Once you practice a few times, you'll find it becomes second nature. Now, even though the process is straightforward, there are some common mistakes that can cause major confusion. For example, double entry mistakes, where a transaction is entered twice, or reversal errors, where debits and credits are swapped. Sometimes people record payments or receipts on the wrong date, which makes matching difficult. Other common issues include missing standing orders or using the wrong bank statement for the period you're reconciling. To avoid these, always cross-check your figures against the source documents, invoices, receipts, and statements. In reconciliation, accuracy matters. Small errors can ripple through the entire bookkeeping process. Finally, let's talk about why reconciliation is so valuable to a business. First, it helps detect fraud or unauthorized payments. You'll notice immediately if money has left the account unexpectedly. Second, it confirms the accuracy of your cash book. Third, it ensures the business always knows its true bank position, not just what's on paper. And finally, it builds confidence in your financial reporting. So, to summarize, bank reconciliation is not just an administrative task, it's a vital control that ensures trust, transparency, and accuracy in the accounting process.